Whilst we're waiting for the FOMC meeting, I want to show you another chart which shows the average maturity of world government bonds, which has just now fallen to 8.8 years. And that's the lowest level since 2014. And just to give you some perspective, since 2021, the average maturity has dropped by 1.5 years, which means governments are basically borrowing money for shorter periods than before. Instead of looking for long-term debts for 10, 20, 30 years, they're going now for short periods. Now you might ask, why do they do that? Because demand for long-term government debt has weakened significantly and governments are turning to short-term treasury bills instead. And who is driving this the whole move? It isn't small countries. It is the UK, Japan and the United States. These are the biggest debt issuers in the world. The UK has cut long-term bond issuance to an all-time low this year. Japan is increasing short-term issuance because there is very little demand for super long bonds. And the US is relying heavily on short maturity treasury bills to finance widening deficit. Basically, investors aren't excited about holding long-term government debt anymore. And here is something even more interesting. Both the Bank of England and the Bank of Japan are running quantitative tightening, which means they're reducing their holdings of government bonds. So not only demand is falling, but the biggest buyers themselves, central banks, are stepping back right now. That forces governments to issue shorter term debt simply because that's where the demand still exists. But this could be very, very risky. Why? Because short-term borrowing is cheaper in the moment, but it has significant side effects. It has a dangerous side effect. When governments borrow short, they have to refinance more often. So if interest rates go up in the future, their debt costs can explode. And imagine having a huge credit card bill. And instead of locking it at a fixed low rate, you choose a floating interest rate that can jump anytime. That's basically what the governments are doing right now. And they're exposing themselves to short-term interest rate volatility. So this means if central banks raise rates, if inflation sticks around, and if markets demand higher yields, government interest payments will skyrocket. And we already know that the government debt is completely out of control as it is, and this is making it even worse. And there is only one exit out of all of this, but I'll tell you shortly. Transferring that to us as investors, most of us, we look at markets emotionally, not structurally. We are focused on price charts, we're focused on narratives, we're focused on hype, while ignoring what's happening underneath the surface of global finance. We've seen this pattern repeated in 2008, in 2020, during every liquidity cycle in history. And humans underestimate slow structural risks and overreact to short-term noise. And as you know, right now everyone is expecting the FOMC meeting, the CPI prints, the Fed meetings, interest rate decisions and speculations and so on. But very few people are asking, what does the global debt structure looks like? Who is buying government debt? What happens when refinancing costs explode? These are the questions that determine the next macro cycle and where we are heading, not today's headlines. And when we have these short-term debt dependence, this makes the government incredibly vulnerable to liquidity shocks. And historically, moments of government debt stress led to two potential outcomes. One is money printing and the second one is higher interest rates. And both of those are actually bullish for Bitcoin in different ways. So if governments are forced to monetize debt again, that's basically more liquidity and more money entering the markets. And that's the money printing, which I think we're going to see in 2026. And if interest costs explode, trust in fiat system weakens. When the trust in fiat system weakens, then we expect Bitcoin and gold to rally. Either way, long-term thesis for crypto strengthens in those two cases. And the issue is that most people don't realize that they won't know about this until it's too late, because human psychology is strange. We reflect and we react to emotional stories, not to slow trends. We chase pumps, we chase hypes, we panic on the dips, we follow headlines, we are panicking on the news. But the biggest opportunity comes from actually understanding macro trends before the crowd sees them. Short-term thinking is how the average investor behaves, but long-term thinking is how wealth is actually built, which is what matters to us. So that's for me today. Thanks so much for watching. I'll see you in the next video.